and I'm the Vice President of Professional Services for MMP across the country. With me today as well is Marty Clement, who's one of our partners in our Canadian tax group, and Marty's in Kelowna today. And then Nick Korhonen, who is in our Ottawa office, who's also part of our tax group, who work with our private business clients and our professional clients across the country. So we spent a lot of time on this issue. This is obviously, we've got lots of people on this line today. This is a very important issue to a lot of Canadians, and so what we found, certainly across the country, we've been having discussions over the last 2 weeks in particular. So maybe what I'll do is I'll just give a little bit of background in terms of where these rules or these proposals by the Finance Minister came from. So there's our map of Canada. So anyways, we're in all those places, of course, and have been working with private clients for 60 years now, and so this is our bread and butter. Certainly the Liberal government, the Trudeau government was elected in October of 15, and at that time their Red Book, or their platform, essentially said that they were running to assist the middle class and growing the middle class and growing having economic growth in Canada, and that they also wanted to end all tax breaks for the wealthy. And so they certainly, they ran on that basis, and over the last several years, the changes that we've seen, certainly when they were elected in October, Parliament was called back before Christmas, and they announced increases to tax rates to individuals who made over $200,000, the perceived wealthy. There were reductions that were supposed to occur in terms of the small business tax rate for small businesses, of which many of you on this call certainly would qualify for. And then they stopped those. They were supposed to drop 2 percentage points, and they only reduced them a quarter of that, on the basis that that was also helping the wealthy. In the first budget, they also then introduced measures whereby it was harder to access the small business deduction for a number of clients. And so certainly we saw impacts on a lot of our professional clients at that point in time, and a lot of other small businesses as well. So, and then this year, certainly in the budget that just occurred in March of this year, the government announced further changes in terms of how what we call work in progress is taxed. And so essentially they talked about ending a deferral, and this really impacts, for the most part, lawyers and accountants, once again, the perceived wealthy. The government at that point in time had also announced increases to the funding of CRA, the Canada Revenue Agency, to allow for more money for auditors, for more enhanced equipment and softwares to find tax cheats and that sort of thing. So we certainly have seen over the last almost 2 years a real movement towards looking at high income earners as I wouldn't say a cash cow, but certainly that's been some perception there. In the budget that was introduced in March of this year as well, the Finance Minister said that they would be producing a white paper, a discussion paper, as to tax loopholes that assist the wealthy who have private corporations. And certainly at that point in time, we've been waiting for the last several months to see these proposals that we're going to talk about today. The initial thought was that a lot of these measures would only impact professionals who, once again, are felt to be wealthy and have the ability to pay additional taxes. But certainly as we've gone through these new proposals, and Nick and Marty are going to go through them in much more detail, there are some pretty profound impacts, not only, of course, on professional clients across Canada, but also on anyone who has a private corporation. And certainly if you take a look at where I'm at, I'm sitting in my office in Edmonton this afternoon, about 95% of what you see out there in terms of businesses are small private enterprises. So the implications to some of these, we'll talk about that, are pretty pronounced, and to a large extent are certainly going to have big impacts in terms of what people can do in terms of capitalizing in their companies and expanding. Certainly implications to people who are looking to retire and what monies might be available for retirement. And so all of these pieces are all around trying to essentially work towards making leveling the playing field. But I think probably a lot of you have read, in many publications in the last few weeks about how perhaps this is not such great policy, and we're going to talk about that as well. But at this point in time, I'm going to turn it over to Nick, and he's going to start on exactly what came about in the proposals and how they impact you. Thank you.
Thanks, Cal. Appreciate that. So the first thing we're going to look at today is the proposal to income sprinkling and what the government's looking to change in the income splitting rules currently in place. By way of background, then, it would be useful to understand what the government is referring to when it uses the term income sprinkling. So income sprinkling is more commonly known as income splitting, which is a term many of you might have heard of before. And generally, it's a tax planning strategy whereby income is redirected from a high-income earner to a low-income earner. So in Canada's tax system, where we use progressive tax rates, the higher an individual's income, the higher their marginal rate of tax is. By moving the income away from a high-rate taxpayer to a low-rate taxpayer, overall taxes paid can be effectively reduced. Traditionally, this is done either by paying a salary to a lower-income family member for work that they do in the business, or by allowing them to subscribe for shares of the business on which dividends can be paid. It also has the added benefit of allowing the multiplication of other benefits like personal income tax credits or the lifetime capital gains exemption. On the next slide, we can see the current graduated rates at the federal level in Canada. So as you can see, individuals who earn more than $202,800 per year now pay a rate of 33% federal tax on earnings above this threshold. This is compared to a low-rate taxpayer who would only pay 15%. When you combine this federal rate with the provincial and territorial rates, most jurisdictions in Canada now have top rates above 50%, which is pretty significant. So in the base scenario where an individual earns all of their income directly, a significant portion of their income is being paid to the government in the form of taxes. This slide looks at a typical structure that many of you might be familiar with. Most professionals across the country are using a structure similar to this at this point in time. So instead of running the practice as an individual, what would typically happen is the professional would incorporate their practice as a professional corporation, and their spouse and adult children would come in and subscribe for shares. Because at the time of the creation of the corporation, there's no value to it yet, the shares that the spouse and the adult child buy only have to be subscribed for a nominal amount, such as $10 or sometimes even just $1. And then as income is earned in the future and the value of those shares increases, profits can be paid out as dividends on the shares owned by either the professional, their spouse, or their adult children. So why do these structures get put in place? Well, as we mentioned earlier, it allows you to redirect income towards lower income family members and therefore effectively reduce your tax rate. Often this is used to finance various expenses of the family in a tax efficient manner. So commonly we'll see it used to fund maternity leave, disability, sabbaticals, to pay for post-secondary education for adult children, and to assist with the purchase of a principal residence for a child who's just finished their post-secondary studies. To put some numbers on the page and show the impact that this might actually have on individuals, we thought we'd walk through a couple of slides. So this first example is looking at Ontario rates just to try to show the impact of these changes. So under the income splitting scenario, a professional would be earning a salary of $200,000 a year, and they might pay a taxable dividend to their spouse of $200,000 per year. So on that total income of $400,000, when they're income splitting, their taxes payable are about $125,000, taking into account graduated rates. Now, if all of that income was paid directly to the professional without taking advantage of the spouse's graduated rates, the personal income tax on that actually increases to $160,000. So by income splitting in this basic scenario, you're able to save about $35,000 of personal tax every year by the household. Another common example we see is where the professional not only income splits with their spouse, but with their adult children. And as I mentioned earlier, this might be to help finance post-secondary education, help purchase a house, or just help them stay on their feet while they're looking for a job after finishing school. So in this case, if the professional is taking their salary of $200,000, and paying a dividend of $40,000 to each of their spouse and 3 children, total taxes payable in Ontario are going to be around $73,600. By contrast, if all the dividends were paid to the professional, the family tax bill would be about $144,000. So you're looking at about $70,000 a year in extra tax if income splitting is no longer available and you're in this situation. So before getting into the actual changes then, we wanted to summarize the policy a little bit and look at why the government's concerned with this. So the government's had some comments, including that the current tax rules around income splitting are fairly limited in scope and only apply to certain forms of income splitting. So the structures that you've seen here would be affected by the existing rules, but it wasn't really a material impact to the point that it was discouraging that kind of structuring. The government's concerned that family members receiving sprinkled income may not have contributed to the business, and they feel that in order to get money out of the business, you either need to be contributing in the form of labor or contributing capital to the business endeavor. Further, the tax benefits under these structures increase with higher income and with more family members to receive the split income. So the government sees this as unfair, as the benefits aren't the same to everybody. Now, what's interesting is throughout its commentary to date, the government keeps referring to this planning as a loophole. And generally, for something to be a loophole, the result has to be contrary to the intention of the legislation. So the government is posturing right now that the results of these changes, or of this structuring, is contrary to what the legislation intends. And I thought this was interesting in the context of a quote that we found from the 2005 Ontario Finance Minister's budget announcement. So in the quote, Finance Minister Greg Sarbaras stated that as a result of negotiations with the Ontario Medical Association, they were extending the ability to professionals to introduce family members as shareholders. So contrary to what they're saying where this is an unintended consequence, you can see in Ontario anyway, it was actually a very deliberate decision to allow income splitting as a way to compensate professionals without having to increase provincial funding towards their fees. So our initial thoughts on these changes then, as Cal mentioned, they're very broad and far-reaching, will impact a number of people. So the proposals, even though the government has been saying they're targeted towards high-income earners, they'll actually impact basically every middle-class business owner who's in a corporation. It's a very, very common structure, and from talking to our clients across the country, the vast majority of them are going to be impacted by proposed changes to income splitting. It's interesting, we find that the government draws parallels between employees and entrepreneurs. Throughout the policy paper, they say that an employee and an entrepreneur should have essentially equal taxation. And what's interesting there is they fail to take into account a number of differences between these two completely separate groups of people. So they don't look at the fact that entrepreneurs and business owners don't have retirement pensions, they don't have employment insurance for job security, there's significant financial risk taken by them in starting their business in order to employ individuals in the economy. They don't have access to benefits like maternity and paternity leave, no health benefits. And there are often significant sacrifices made by family members of business owners in order to support the business venture. So with that said, with that background, what's the government proposing to do? So there's two main changes, generally speaking. The first is that they're looking to extend what's called the tax on split income, or the TOSI rules. You might know this as the kiddie tax, which is a rule that's been in place for a while but used to be much less broad than the proposals are proposing to implement. They're also going to limit the availability of the lifetime capital gains exemption for family members. So for a little bit of background on the tax on split income, known as the kiddie tax, this is a rule that was introduced back in 1999 to address planning where shareholders were paying dividends to minor children to take advantage of their tax rates. It made sense back then that it didn't really make sense to pay a dividend of $40,000 a year to a 2-year-old, and the policy might have been reasonable. But up until now, these rules only ever applied to minors. Under the tax on split income, dividends, business income, and non-arm's length dispositions of small business shares we're subject to the top marginal rate of tax. So you don't get access to graduated tax rates or to some personal tax credits. And what they're proposing then is to extend these rules so that now the tax on split income will apply to all Canadian residents regardless of their age. So it's no longer just minors, it'll apply to anybody of any age who received income from a related business. And you'll note here, we'll talk about this later, but that there's a caveat that it only applies if the income is not reasonable. They've also proposed to expand the definition of the split income concept to apply to other types of income, such as interest from certain debentures, certain dispositions of property. So accompanying these changes, they've introduced a reasonableness test. And essentially what they're doing is they're trying to equate dividends now in this other split income with salary, where they're saying there needs to be some sort of contribution by a family member in order for them to be entitled to receive a dividend or interest or one of these other types of income. If the amounts are considered to be unreasonable, the tax on split income will apply, and the amounts will be taxed at the top marginal rate of tax. So the question becomes, how do we determine what amount is reasonable? This is likely going to be the most contentious issue going forward, as there's no bright line test to say what a reasonable amount is that could be paid to family members. Instead, a number of factors outlined in the legislation need to be considered. So there are actually two separate reasonableness tests that have been introduced. One applies to individuals ages 18 to 24. The second applies to taxpayers who are over 25. And the test for individuals aged 18 to 24 is much more stringent than the other reasonableness test. So in this reasonableness test, they look at labor contributions and capital contributions by the individual. For labor contributions for somebody 18 to 24, they have to be engaged on a regular, continuous, and substantial basis in the activities of the business. This essentially means that they're going to have to be employed on a full-time basis to meet the reasonability test. And with respect to their capital contributions, if they make an investment into the corporation, the amount that is unreasonable will be considered if it exceeds a prescribed rate of return on the value of the assets they contributed. Now, an important point here is the prescribed rate is currently 1%. So in an example where an adult child contributed $100,000 to the business to help finance working capital or purchase equipment, they would only be entitled to $1,000 a year, 1%, within the certainty of it being considered reasonable by the government. The second test applies to individuals over the age of 25. Now, this is less stringent than the first reasonableness test we looked at, but there's still some ambiguity that needs to be navigated. So for labor, they need to be involved in the activities of the business where they've contributed labor that otherwise could have been remunerated by salary. So you'll notice that that requirement for being engaged on a regular, continuous, and substantial basis is no longer there. So you no longer have to be a full-time employee. And then for the capital contribution side, it simply states the individual has to have contributed assets or assumed risk in support of the business. Now, this is a little ambiguous where there's no bright line. It doesn't say it has to be a significant amount of assets. It doesn't give you any sort of hint at the dollar value. But in the examples in the explanatory notes, they have an example where a 26-year-old subscribes for new shares for $10 and receives a dividend. And they said it was unreasonable because the amount contributed wasn't material. So even though the legislation doesn't include any sort of concept of materiality, it looks like that might be the intention, and that might be how this test is applied going forward. So some other considerations. At this point, we have received draft legislation with respect to the changes to the income splitting rules. If the rules are implemented as proposed, the changes will apply to 2018 and later years. So they're not effective as of the date of the announcement like some of the other rules that Marty will talk about later. This means that we have a bit of time still in 2017 to come up with a plan and to evaluate our circumstances to see how this will impact us. Because of the timing of the planned implementation, we can probably expect to see final legislation by the end of 2017. And generally, we would recommend waiting until we see the final legislation so that you can account for any potential technical changes or amendments to the proposals before deciding how to move forward. So tax planning, what can we do about all this? Well, it's really going to depend on your specific facts as an individual. So as a starting point, you need to evaluate your strategy in the context of where you are in your professional life cycle. Somebody who's just starting out their career is likely going to be impacted in a much different way than somebody who's nearing retirement. You know, somebody with kids versus without kids, married versus not married. It's going to make a significant difference. If you are already income splitting, you might want to consider paying a larger dividend to adult shareholders in 2017 to fund their expenses for the next few years instead of paying 1 year at a time. Since we can still do that in 2017, you can still take advantage of their lower graduated rates. Going forward, we need to evaluate the ability to pay dividends to family members in 2018 and beyond. So you have to look at what kind of contributions they're making. Are they making labor contributions? Are they making capital contributions? And if so, is it reasonable to continue paying them a dividend? So subsequent to 2017, it's not that income splitting is dead. It's that it's going to be fact dependent on everybody's specific fact pattern, and every individual will have to evaluate their circumstances to see if it's still a possibility. With respect to documenting the reasonability, documentation is going to be more important than ever. CRA, when they come in and evaluate payments made to family members, will start off on the assumption that the amount is unreasonable, and it will be up to the taxpayer to demonstrate that there is a reason and that the amount paid to the family member is reasonable in the circumstances. And you can also consider alternate remuneration strategies. So as I mentioned, these rules apply to dividends, capital gains, interest, but the tax on split income rules do not, for example, apply to salary. So where you're paying a salary to a family member, if CRA deems it to be unreasonable, the deduction gets denied to your corporation, but the family member still gets graduated rates. So there will be alternatives that are still available in the future. In addition to the dividend changes, we also mentioned earlier that the split income definition was expanded to include taxable capital gains from the disposition of property. This is going to have a significant impact on any individual business owner who intends to sell the shares of their corporation in the future. In many of these cases, we've structured the shareholdings of the corporation so that family members, such as a spouse or adult children, have shares that have accumulated value. So on an eventual sale, you'd be able to claim their lifetime capital gains exemption. And remember, the lifetime capital gains exemption provides an exemption from capital gains up to $835,000 received on a disposition of qualifying small business corporation shares. So this means that historically, for every individual shareholder, they could receive about $835,000 tax-free on the sale of a business. That's no longer going to be the case under the new rules, and the next few slides will look at how that's going to be implemented. So the Liberal government introduced a couple new constraints on the ability to claim the lifetime capital gains exemption. These include age limits, reasonableness tests, and some changes with respect to trusts. As noted on the last slide, Finance believes that it's unfair that the lifetime capital gains exemption can be claimed by an individual who hasn't substantially contributed to the business in the form of either labor or capital. So the new rules are proposing that the gain on the shares must be reasonable, similar to the payment of dividends. So under these new proposals, here are some of the changes to the lifetime capital gains exemption. So a minor will no longer be able to claim the lifetime capital gains exemption for dispositions after 2017. Prior to the implementation of these rules, you could actually allocate shares with value to a minor, and they could claim their exemption in an arm's length sale. For adults, their ability to claim the capital gains exemption will depend upon a number of specific tests. To the extent that the gain is accrued before they turned 18, they won't be able to claim the exemption. To the extent that the gain was accrued while the share was held by a trust, no exemption will be available. And then finally, to the extent that the taxable portion of the capital gain from the disposition is included in their TOSI or is considered to be unreasonable, the capital gains exemption won't be available. Fortunately, with respect to the changes to the lifetime capital gains exemption, there will be a transitional relief period. So the government has indicated what they'll allow is in 2018, an election will be available where an eligible taxpayer can elect to trigger their gain and claim their capital gains exemption for anything that's accrued prior to this date. To make it easier to qualify for this election, the rules that currently require certain asset tests to be met over a 24-month period are being changed to 12 months, so you can modify your structure today and qualify in 12 months' time to crystallize your capital gains exemption. Some planning with respect to the capital gains exemption. If at all possible, you should be looking to try to crystallize the capital gains exemption in 2017 instead of waiting for the election in 2018. When we've seen elections like this in the past, such as back in 1994, there's been significant audit activity around these elections, and it's been quite time-consuming and costly for taxpayers. So if you can trigger your gain this year instead of waiting until 2018, you may have an easier time dealing with CRA. If necessary, you do have the 2018 election available to you if you're not able to claim your gains exemption in 2017. Further, if you have any transactions contemplated this year, it'll be far less complex and there'll be more flexibility if you can push to close the deal before December 31st. So if you're planning on selling your business in the next year or so, you might want to consider accelerating that process. A major consideration that needs to be taken into account is also the alternative minimum tax. So with the lifetime capital gains exemption, even though you get money tax-free, there's a calculation of an amount of minimum tax that might still apply. Now, where this amount is refundable in the future, you still have to come up with the cash up front to pay the tax. So that needs to be carefully managed with the other sources of income. And in addition to all this tax planning, we also need to be careful to balance family law issues, succession planning, and operational control with the need for sound tax strategy. So keep in mind there still might be reasons to have these structures in place if you've implemented them for reasons other than tax planning. And with that, we'll pass it off to Marty, who's going to walk through the passive income changes.
Well, thanks very much, Nick. And the next proposal that we're going to cover is passive investment income in private corporations. And this is an area where a lot of clients have certainly been concerned, and it's starting to gain some traction in the media. So hopefully over the next few slides we can give you some insight as to how the government's proposing to operate these new proposals. So I thought it would be useful to generally review our current tax system as of today, just to outline a few basic concepts before we look at the proposed changes. So number one, our tax system is based on the principle of integration. And so integration basically says that one should be indifferent whether or not they earn their income directly as an individual or indirectly via a corporation. And so the numerical example provides as follows. If a corporation earns $500,000, the corporation would pay $75,000 of corporate taxes, and that's assuming a 15% small business rate. It could then distribute the difference, which is $425,000, to the individual shareholder as a dividend. And so we know that when the dividend is paid out and it's received personally, personal income tax applies, and in this case, the individual would be left with $235,000 of after-tax personal funds for investment. In contrast, if the same income is earned by an employee, the employee is left with $235,000 for their after-tax personal funds, and they've earned $500,000, and then they effectively pay their personal income tax up front, which is $265,000, sort of assuming some general Ontario rates. So ultimately what we can see here is that the same amount of taxes are going to be paid, whether the business's income is earned through the business, would be in the corporation, or by the employee. The only real difference is the timing of when the taxes are paid in full. So to establish fairness, the government's identified that the difference between A and B really provides the entrepreneur with an advantage. So in the government's view here, the difference provides an entrepreneur with a benefit because they would have a higher amount of capital to invest passively, and this is not otherwise available to others. So they're seeking to remove the benefit of being able to invest more capital unless the benefit, which is the more capital, is directed towards investment in growing a small business. So the next slide is just sort of continuing with our integration example, but rather than earning business income, we're going to just take a look at how our current system works with investment income. So in regards to the employee here, if investment income, in this case simple interest income, is earned of $500,000, it's subject to the highest personal rate. So that's about 50%. So the employee here is left with $250,000. In contrast, if you earn the same $500,000 of investment income in a corporation, a 50% corporate tax currently applies. However, about 30% of this tax is refundable, and it's refunded to the corporation when the corporation distributes its earnings to an individual, because the individual is again subject to personal income taxes. So the slide points out here that as it currently stands, there's no material advantage to earning investment income in a corporation when compared to earning investment income personally because of the way the refundable tax system works. So deferring income is really important because it allows a business owner to acquire assets that are not necessarily directly related to his or her business, and that's really to diversify risk. And as Nick was sort of indicating, that deferring income also allows a professional to save for retirement because he or she does not usually have a pension plan. And it also allows a professional to accumulate funds in the case the professional becomes disabled, sick, or goes on sabbatical, or takes a maternity or paternity leave. One of the more important things with being able to defer income and maybe investing it passively for a period of time is that it allows an entrepreneur to access capital and to be opportunistic and ultimately create more employment opportunities by spending. So while there is a benefit to deferring income in my view is not just necessarily to simply provide a personal benefit. So in a number of instances here, the ability to defer income allows small business owners to manage a number of realities that they assume when they go into business for themselves. And in contrast, arguably, employees don't have such realities. So what's all the fuss about? Finance Canada is really concerned that entrepreneurs or small business owners, being professionals, are obtaining too much personal benefit from the current system. And so we'll take a look at that on the next slide. So sorry, just before we jump into that, there's a couple of points that I think we need to just chat about first. And so we don't have draft legislation, unlike the income splitting that Nick was talking about. So what the government has done right now is they've brought forth proposals regarding implementing these changes. We've only seen these proposals, and these proposals represent a significant overhaul to the taxation of investment income in a private corporation. And so with such an overhaul that they're proposing, we're hopeful that the government is going to provide more than a 75-day consultation period before any systems are effectively changed. So the government's outlined 3 proposals, and we're going to review these at a high level. And so again, just being mindful of the changes that may come here, the government has committed time before any such proposal becomes effective. And so what this means remains to be seen, but we're really hoping that the government isn't going to really hit a light switch like they've done with some of the other proposals that we'll get to in the next section. So by all accounts, the government does recognize the complexities that would be involved with such an overhaul. The government has also endeavored to grandfather existing passive assets that are in private corporations without specifically commenting on this. So proposal number 1 is actually from 1972, and interestingly enough, the proposal was enacted and repealed because it was too complex. So if we're continuing with our example, if we have $425,000 to invest in a passive asset, under this particular proposal, the government would levy a refundable tax of $175,000, leaving the corporation with $250,000 to invest. If the corporation acquired a business asset at a later date, the $175,000 would be refunded to the corporation. So you can imagine the practical implications that such a proposal would create, but you can clearly see that what their intention here, and what their intention here is that they really want to leave the corporation with $250,000 to invest passively, which would be the same amount that an employee would arguably have after paying all of the personal income tax rates associated with their income. So under the second proposal, which is called the Apportionment Method, no tax would be levied at the time a passive investment is acquired. So again, continuing with our with our example, the business would have $425,000 to invest. Now, rather than taxing the capital, or putting a refundable tax on the capital, the proposal proposes to significantly tax the income generated by the capital. And we'll take a look at the example as to exactly how this is going to work. So under the apportionment method, if we've got $1,000 of investment income that's earned, 50% non-refundable tax would be levied on the investment income, and this would be applied at the shareholder level. This would leave $500 of investment income to be distributed based on the source of earnings that the small business would have. So small businesses would be required to track their source of retained earnings, and the retained earnings sources would be tracked, and then they would be determined on a percentage basis, and the $500 of investment income would be distributed to the shareholder based on the source of income used to acquire the asset. So the key point here is that there's no refundable income tax in the proposed system, and we're going to get back to that because that's really the critical component. The last proposal here, which is called the elective method, it's similar to the apportionment method except that there would be no tracking, which would ultimately probably simplify matters. So again, a 50% tax rate would be applied at the corporate level to all investment income, and the after-tax passive income would then be distributed as an eligible or an other than eligible dividend to the individual shareholder. So we're going to take a look at the proposed system in action, absent the refundable income taxes at the corporate level. So just a couple of general points here. So I've assumed that the shareholders here are subject to the highest marginal rates of income tax in both cases. And so we'll start with the employee. So again, continuing with our example, if the employee had $235,000 to invest, he or she would be entitled to a theoretical return of $23,500, assuming that there's a 10% return on that particular asset. At the end of the day, the employee would be left with $11,750. So to establish fairness, according to our government, the entrepreneur would have effectively be subject to a tax of approximately 71% on their investment income earned in a corporation to level the playing field. So we'll just take a closer look at the 71%. And in fact, in Ontario, the amount is 73%. I've just used some general numbers here reflecting all of the provinces in Canada. So again, here the corporation has $425,000 to invest, so more than the employee, and they would earn $42,500 of interest income because of the fact, again, they have more capital. So rather than applying a refundable tax, the government is proposing to apply a 50% permanent tax on the investment income earned by the corporation. So this would leave the corporation with $21,250, and when this income is distributed, it would again be subject to personal income tax in the form of a dividend. So as a result, once that income is distributed, the entrepreneur would be left with about $12,000, which is a similar amount when compared to what the employee would have been able to net. So the fundamental change here is that we're not going to be able to be benefiting, there'll no longer be a benefit associated with investing a higher amount of capital in the corporation when compared to what would otherwise be able to, you'd be able to earn personally. So just a couple of general comments here. So, you know, if the proposals as written are enacted in any shape or form as what they're currently saying, it's going to be absolutely critical to make sure that you're examining your own situation, because the proposals have the potential to reshape many retirement strategies, and they're potentially profound. So in some cases, professionals may have to examine the merits of maintaining a professional corporation if the ability to defer income and invest passively is going to be taxed in such ways that they're proposing. So because we're only dealing with proposals, any tax planning that would be done today would clearly be speculative, and it's not necessarily recommended. So some clients have started to ask us about other things associated with investments such as permanent life insurance policies, or the possibilities of maybe redirecting investments into other small business corporations rather than the stock market. So in both cases, it's not really clear yet as to what the government plans to do with life insurance policies where the investments may grow tax-free in the policy, so hopefully they don't make any changes there. And again, we're not entirely sure yet, or it's not yet clear from the government as to whether or not we'd be able to invest in other small businesses, or what would be a good investment, or what would be ultimately a bad investment. So, and that's from a tax perspective. So it's going to be really important to follow this situation along very closely, and we should have more information in October. So moving on to the last proposal. The last proposal concerns converting income into capital gains. So prior to this change, a number of tax planning strategies were available to private business owners, which would effectively allow a private business owner to convert dividend income or salary income into capital gains. And so the planning, which was opportunistic, was attractive because capital gains are taxed at a rate of 50%. So there's certainly savings that could be generated by creating capital gains. And we'll take a look at what that looks like on the next slide. So for Finance Canada, an individual in 2016 resident PI, if they were able to successfully convert $100,000 of salary to a capital gain, this planning would have saved that individual about $26,000. Now, if they were able to convert a $100,000 non-eligible dividend to a capital gain, about $18,000 would be able to save. And then finally, if $100,000 was converted from an eligible dividend to a capital gain, the individual would be able to save about $8,530. So the government was really concerned that the capital gains, when they were realized in corporations, were really providing a mechanism to remove corporate surplus to the individual levels without the appropriate amount of tax being applied. So the government really didn't like this kind of planning, and so effective July 18th, 2017, any self-dealing transactions that would produce tax savings were effectively eliminated by proposed legislation that we're in receipt of. And so the legislation as it's drafted also potentially has the effect to retroactively capture some transactions that have occurred but have not yet been paid out to the shareholders. So for today, what we're going to do is we're not going to necessarily discuss the planning opportunities that are no longer available. Rather, what we're going to do is we're going to walk through an example of these proposals in the context of estate planning because there's some important changes to be aware of in that context. So example number one, and this will be our only example, we're going to assume that Kate is a professional and she owns shares of Holdco. The fair market value of those shares are $2 million because Holdco has $2 million of cash in it. The adjusted cost base of Kate's shares are $100 because Kate subscribed for shares for a nominal amount a long time ago. So Kate passed away after her accountant confirmed what she'd been reading in the Globe and Mail concerning small businesses and how the Liberal government plans on taxing them. So in terms of Kate's estate plan, Kate has a capital gain of almost $2 million on death, but again, all of that money belongs to the corporation. And so where we're currently at, a potential situation for double tax may occur under the existing rules. And so double tax may occur because you pay tax in regards to the capital gain on the shares, and that's on the terminal T1, and income tax again on the distribution of the assets from the corporation to the estate. So generally speaking, there are techniques available to eliminate one of the two taxes. And so you either eliminate the capital gain on death or the dividends from the distribution. So because of the favorable rates applicable to capital gains, many estates would plan into paying capital gains rates as their final tax bill when compared to dividends. And so if you're planning into capital gains tax, this would be done via what's called a pipeline in practice. So again, Kate's had a deemed disposition on her T1 final return, and she's had that $2 million capital gain. And so what happens is that her estate acquires the shares with a $2 million adjusted cost base, and that's as a result of that deemed disposition on death. So remembering that we want to pay capital gains tax rather than tax on the dividends by liquidating Holdco, the estate sells the shares to Newco for $2 million. And there's no further tax here because the adjusted cost base of the shares equals the fair market value. So Newco has no money because it's a brand new company. So it issues the estate a note to pay for the shares when it in fact has money. So here what would happen effectively is that Holdco would purchase the shares from Newco, creating an intercompany dividend. And so intercompany dividends are not subject to corporate tax so long as the dividend is paid from the corporation. The dividend that's paid from the corporation to the other corporation has already been subject to tax. So in this case, we're able to move the money from Holdco to Newco with no further corporate tax. And then in step 4, Newco would be in receipt of $2 million and owes the estate the promissory note. So under the new rules, what they're proposing to do is that the estate is not going to have access to that adjusted cost base of $2 million that occurs on Kate's death. And so as a result, if the estate were to transact using the old pipeline rules, it would be deemed to be in receipt of a dividend, but the estate would already have also had a capital gain. So there's potential there that double tax may really occur. So essentially what they're saying here is that an estate can no longer plan into capital gains tax. Rather, the estate will need to liquidate holdco, giving rise to a dividend. So once holdco is wound up, we can deal with the capital loss, but effectively we're now in a situation where we're paying dividend rates on death as opposed to capital gains in the context of private companies. So here are the numbers with our hypothetical example. So in the context of capital gains planning, if you have a $2 million capital gain on your private company shares, under the old rules you're looking at a final estate tax liability of about $480,000. Under the new rules, if there's no pipeline that's available, again, we're looking at the dividend rates here, and so the estate would have a tax burden of about $840,000 when compared to the available planning options that used to be available to us. So a significant change here in regards to the taxation of estates and how much tax they may in fact pay one day. So again, just a few key points here. So if this legislation is enacted, and we do have a majority government, and we have seen legislation here, so we would expect that this legislation would be enacted. It would be absolutely critical to manage any accrued gains on your corporate shares during the life of a professional to really sort of manage the estate tax liability now that it's going to be bigger. And the other thing here that may warrant some consideration is you may just want to review your estate and how much tax your estate may have to pay, and whether or not you're properly insured or whether or not you've got other assets to take care of all of your obligations. So just finalizing here, the last rule that they've put into place here is a surplus stripping rule. And just like the rule we were talking about before, this is effective for transactions effective the release of the policy paper date. And so anyways, these new rules have generally been introduced, again, to prevent a shareholder remove corporate surplus as a capital gain in a non-arm's length context. So just to the extent that you're reorganizing a business, or you're selling your assets, or you're transacting on a basis where you may realize a capital gain hoping to pay out half of the capital gain with no income tax consequences at the personal level as a capital dividend, it would be really important to seek professional advice and just to make sure that you're not running afoul of any of these new rules that are effective immediately in July. So that's the end of the technical component of the presentation, and I'll just turn the slide deck back over to Cal for some final comments.
Thank you, Marty. In terms of all of these three proposals, obviously for those of us here in practice, we see multiple implications of this. Certainly the income sprinkling, that is used quite extensively in private business and in professionals, and obviously you saw the tax repercussions or the increased taxes as a result of not being able to do that. Certainly very far-reaching is the taxation of these passive investments. Obviously, as Marty and Nick talked about, that would have a big impact in terms of retirement planning. That would have a big impact in terms of just monies available in the economy to effectively expand businesses and that sort of thing too. The capital gains, the treatment that way of monies that typically might have been dividends, treating them as capital gains also has an impact. There's been a lot of interest, obviously, in these three proposals. Myself, I've been very much involved over the last 2 weeks in terms of how we can help our clients and how we can help our clients through their various associations to try and participate with finance, with the government before the consultation period ends on October the 2nd. I know lots of you have lots of questions. We're going to move to that right away here. We won't have an awful lot of time to go through questions, so we will be circulating as well. We have prepared what's called frequently asked questions with answers, and so anyways, we've got those, so we will be providing those to you as well. So with that, I think I'm going to turn it over. I know that Nick and Marty are prepared to answer some questions, and I believe that there have been some questions circulated, so I'll turn it back to Marty and Nick.
Sure. So we've got one question here, and I think this is a good question. And so the question is will the tax changes impact an existing corporate investment portfolio of retained earnings, or be limited to future retained earnings. Okay? So what the government has said in their policy paper is that they realize that there are a lot of businesses out there with a lot of capital and a lot of portfolio investments in them. And so what the government has said is that they have considered the fact that it will be necessary to grandfather some of these companies. Now, what they haven't done is they haven't articulated, or they haven't really clarified exactly what grandfathering means. So they're certainly conscious of it, and they do appear to be entertaining the concept of grandfathering with this, which is good. But I guess my concerns here is that when there's a significant overhaul of the tax system that's being proposed, and you're looking at grandfathering, various different scenarios, with the complexities that it would be involved from switching from one system to another, I'm just hoping that all of the existing portfolios would effectively just be, under the new rules prospectively, and that, there's not any sort of collateral damage. Nick, did you have anything maybe to?
Yeah, I think what's going to be interesting is going to be, how they go about this. And like you said, there's going to be something that falls through the cracks, and we don't know what that's going to look like. So in our conversations we were recently having, one of the things we identified is under the proposed changes they're proposing to get rid of the capital dividend account, for instance. So right now, if you have a capital gain of $100, you get $50 of that you can pay out as a tax-free dividend to the shareholder. Under the new rules, that would no longer be available. But for example, what happens where you have $1 million of accrued gains in your investment portfolio today, and then these new rules come into place? If you sell those shares 2-3 years from now, do you lose out on that 50% capital gain, or do we have to trigger the capital gain today to get the CDA? But in doing so, you would trigger a lot of tax up front. So it's going to be interesting, to say the least, to see how they propose to capture all this, to make sure that they grandfather it properly. There's going to be a significant amount of complexity, and it's going to be quite difficult to follow, I think.
Yeah, I think that we're going to have to monitor that one very carefully, and to the extent that you have a significant portfolio or any sort of portfolio, I think that you're going to clearly want to understand exactly how the proposed rules are going to work well in advance of any implementation of those new rules, just so that you're in the best position as possible to make any adjustments you may need to make. So I think it's stay tuned and follow that very closely. So Nick, there's another question here about passive income. So we've got, again, there's the capital that's already in these corporations, and so again, when we're talking about prospectively, do you suspect that these proposals are going to apply to passive income going forward, and that it's only going to apply to sort of future active business income and future investment income?
So the way I see it being implemented going forward is that any passive income earned after these rules are implemented will be under the new system. Otherwise, the level of complexity would just be far from manageable, where you would have to track what portion of your portfolio arose before July 2018 and what portion arose after, and there's just no way they could administer that. So I think going forward, all future passive income will be subject to the new rules.
Okay, well that's great. That's great. So we've got another question here, just sort of concerning, I guess this is more of a policy question, I guess, and I think it's a very good one. And so generally here what the question is that, there's really no mechanism that's in place right now to appreciate the additional time and costs required to attain professional status. And there's really no mechanism to catch up all of the lost income and all of the lost opportunities that a professional has to forego to really develop the capital between their ears. And so are we aware of the government proposing any sort of mechanism to really deal with that fundamental inequity here?
Yeah, so we really haven't seen any proposal that would deal with that inequity. One inequity that we've previously discussed is, for example, RRSPs, where the government is saying that everybody should be using RRSPs. Well, there's a significant difference between somebody who starts work full-time at 22 years of age and earns that $23,000 of RRSP room every single year, versus somebody who doesn't start earning a real income until they're in their early 30s. You've lost out on potentially, $250,000 of RSP room that you would have had if you had worked earlier. Now, with that said, there is planning that can be done to hope to fix that inequity. So options like individual pension plans, maybe retirement compensation arrangements, these other options that weren't as appealing in prior years, under these new rules might become appealing once more for implementation to get some fairness back.
Yeah, I think that, with that sort of inequity that's raised there, I think it's absolutely critical that the government is made really aware of those sorts of concerns here. When I look at these rules, they're in fact punitive if you're going to really develop your, the capital between your ears. And we're heading into a knowledge-based economy here. And so, I would think that you would want to incentivize people to do that as opposed to potentially taxing them like this. So I think it's a great question. I think it's something certainly that maybe your local MP or one of your associations should certainly hear about. So Nick, just a couple of more questions here. There's a question here about the proposals applying to holding companies. And so, Nick, maybe what we'll do, because the question's pretty general, it says, do the same proposals apply to holding companies? Do you want to maybe comment on the income splitting component of that, and I'll talk about the investment, the taxation of investment income?
Sure thing. So from an income splitting perspective, it will apply, and in fact, it'll be slightly more stringent than it would be in an operating company, where they look at the reasonability test and they talk about labor contributed or capital contributed to justify the reasonability of dividends. In a case where a company only earns passive income, where it's a holding company, they've said that the labor contribution will be deemed not to count for anything in the reasonableness test. So even in a case where you have a couple of rental properties and say your adult child was managing those properties for you and really contributing, because only passive income is being received in that company, that child's contribution would be deemed to count for nothing. So it will absolutely apply to holding companies. It might actually be worse.
Yeah, so in regards to the proposals in the holding company in terms of taxing passive investment income in private corporations, again, we're hoping that the government is going to certainly grandfather some of this, but what they have identified is that they've identified the fact that that holding company likely has an amount of capital in it that an employee wouldn't have been able to generate because of the tax rates the employee were subject to. And so it'll be interesting to see how they grandfather this, but they're clearly intending to tax the income that those assets are generated at very, very high amounts, so that there's really no further benefit there in regards to having the ability to invest the higher amount of capital. So I think that's generally it in terms of some of the questions that we're seeing. I'll just maybe give it a couple of more seconds here, and if there's no further questions, I'll turn it back to Cal for some closing remarks.
So it looks like we have one more question there, Marty, which is,
okay.
Would there be a fundamental difference between holding a public REIT versus private rental property? And I guess for this one, it really depends on the context of what rule change you're looking at. So for investment income, there wouldn't be a fundamental difference as far as we know in terms of rental property versus a REIT. It would still be passive income. From an income splitting perspective, there is the ability to have a spouse own shares in a public company such as a REIT versus having a portion of a private company and allowing them to income split. So primarily there wouldn't be much of a difference from the passive side, but there could be a difference from the income splitting side.
Okay. Great. Well, I think we've answered the questions that were asked. As follow-up, once again, tomorrow you'll all be receiving the recorded version of the webinar. Certainly, I would ask you as well, we will be having another webinar when these proposals are finalized or as we get more information. And I can tell you that certainly as a firm, we are working to make our own submissions, and we're helping a number of professional associations and independent business associations to help with their submissions. So this is pretty critical, we think, to the Canadian economy. certainly very critical to professionals and having a healthy bunch of professionals performing services all across Canada, for whether it's doctors, dentists, lawyers, vets, that sort of thing. And so we'll keep you informed. We will have, like I say, those frequently asked questions out right away as well, and look forward to talking to you again soon. So thank you very much for your time today.